What's going on, option investors? My name's Henry, and if you're new, I'm continuing a series on options because that's my area of expertise when I was working for Goldman Sachs. And in this video, I'm going to reveal the best call options to buy for January 2022 based on the research that I've done on 3 specific stocks I think are not only big wins, but also have very attractive options. Before I jump in and flood your pockets with money, make sure that you smash that like button for Uncle Henry and subscribe to the dopest YouTube channel. These calls are going to print money. Well, at least as long as the economy continues the way it is, because after all, I'm an ex-Goldman Sachs, ex-hedge fund analyst, not a genie in the bottle, but I think these plays are highly likely to have success. I have had 96% success in the private option Discord so far, so if you'd like to check that out, then you can do so in the first link below. Buying a call is betting on a stock rising. Calls give you enormous leverage because after your break-even price, it's all gravy and you can only lose what you paid for the option. So a call option is just a contract that allows the buyer to purchase 100 shares of stock at the call option strike price, and it's the easiest beginner option strategy out there. So let's take a look at the 3 best long call option plays that I have for you with the stock analysis of each coming first. The first stock I want to discuss is Activision Blizzard. This was a stock I bought for Drexel University's endowment back when I was in college studying finance and data analytics, and my thesis was that esports would do very well in the future. Just take a look at this chart of how much viewership is actually rising. Activision Blizzard is a large American video game publisher with 3 main studios: Activision, Blizzard, and King. King, by the way, was another driving force behind my conviction in Activision. I believe when I made an investment decision that Candy Crush was increasing bottom line margin for Activision and made my discounted cash flow model screen for the stock as a very attractive investment back when it was about $37 per share. This was about 4 years ago at this point, but I still believe this stock has a really bright future. Activision Blizzard is guiding for $3.1 billion in operating profits in 2021. With a market cap of $63 billion, that gives the stock a forward price to operating income ratio of 20, which is well below the current market average. Price to sales is just under 7. The business is wildly profitable. If you believe in the durability of Call of Duty, the resurgence of Blizzard games, and the continued growth of King advertising revenue, then Activision Blizzard is your bet. If I had time for video games, I'd be one of the 26.6 million monthly esports viewers in 2021. Now let's take a look at call options and do some analysis. What's going on, guys? So I have a little new setup here I'm super excited about, but let's take a look at my portfolio. I am down a good amount of money today, but the good news is all the call options I'm going to be recommending to you guys today are going to do super well, or they should do a lot better than if you were going to open them on Friday, because today the market is down a lot. It's down about 4% for a lot of different stocks, especially growth stocks. It's gonna be really interesting. The first thing I'm gonna be showing you guys is Activision Blizzard. So Activision Blizzard today on September 20th is down 3.59%. It's gonna be really good to take a look at this stock, and I'm currently selling puts on the stock, but that's not what this video is about. This video is about buying call option. I'm gonna go to trade ATVI, and the first thing I'm going to do is I'm going to go down to January 21st, 2022. That's about 3 months from today. Actually, it's about 90 days exactly. I'm gonna go down to the strike price. And basically, guys, what you can do here is if you're really bullish on Activision, I am pretty bullish. I think that this stock could easily be maybe an $87 stock, so we have about $10 worth of upside. Maybe we can even see $90, but $90 would be a little bit aggressive in January, because in 3 months, if this stock were to move about 15%, that 15% would translate into about $10. So let's just say I believe that this stock is an $87 stock. Now, what you can do here is for January 21st, you can go ahead and buy a number of different call options. So one of the first call options you can buy is a near to the money call option, which is a 77.5 call. As you guys can see here, the break even is 82.90. So basically after 82.90, all gravy from there. You just need the stock to go to 82.90. If it doesn't, again, the risk is you can lose this premium right here, which is $540. However, the good news is you can only lose $540. So you have a very good amount of upside potential for a limited amount of risk. The next thing that you guys could do is also buy the 80 or the 82.5. Now, I would not buy the 85 call because that goes into the territory of just too far out of the money, and you would really need Activision Blizzard to move a whole lot very quickly. And I'm not a fan of that because that's kind of a casino mentality where you need something to happen and it must happen quickly. That is a pretty bad situation to be in. So I would rather go for something closer to the money. So I explained the 77.5. Now I want to explain to you guys the 80. So the 80 80 is going to be very similar to 77.5. And the reason why you would pick 80 is because you would have a little bit more leverage. What I mean by leverage is if this stock were to go parabolic, you would only have to put up $430 rather than $540. So you save yourself $110 in terms of upfront cost, but then again, you would need the stock to go up to $84.30 right here, as you guys can see on the screen, because now, although you're paying less premium, because you're having less risk in terms of how much you have to pay up front, the market understands this, traders know this, so they require you to have more upside in the stock because they're not going to give you an 82.90 break even if you're paying less money. That wouldn't make any sense. The farther you go out, the less you pay. However, the more you need the stock to go up to break even. And let's say that Activision Blizzard ends up being about $84 per share. In that scenario, if Activision was to go up 10%, that would be about $84. So if you bought a 77.5 call option, you would make $100 or, roughly $640 on your $540 investment. So you'd be making about 20%, which is not bad at all. $100 doesn't sound like a whole lot, but it's actually about 20%. 6 divided by 5 is about 120%. In terms of the 80 call option, now if Activision went up to 84, guess what? You'd actually be in a pickle. So for me, I'm really heavily looking at the 77.5 call option. Next stock I have on the list with strong call options is Lemonade, ticker symbol LMND. Now for this one, I want you to exercise more caution because buying call options, you can lose all of the premium that you pay. Don't blame me later and say I didn't tell you because you thought I'm a genie in a bottle. Here's why LMND has more risk, but also a lot more reward, and I enjoy the options. Look at this chart. This stock peaked at around $180 per share in January. In July, it was just under $100 per share. And since then, it has trended lower and done completely nothing. This stock is a bet on a turnaround. But when I look at it, it's hard for me to understand why this stock looks so undervalued. Lemonade is a tech company that's disrupting the insurance industry. While traditional insurance providers employ actuaries to estimate risk, agents to sell policies, and adjusters to handle claims, Lemonade cuts back on human inefficiencies with artificial intelligence. Specifically, its digital-first platform uses AI chatbots to engage customers, allowing Lemonade to price policies in just 2 minutes and pay claims in as little as 3 seconds. This results in a delightful customer experience while also keeping the company's payroll expenses low. More importantly, Lemonade's platform was designed to capture far more data than traditional systems. By blending those signals with artificial intelligence, the company aims to quantify risk more precisely. In turn, that should keep its loss ratio, for example, the percentage of premiums paid out in claims, below the industry average, allowing Lemonade to undercut its rivals on price, or just spend more money on advertising dollars. This creates a network effect. As more consumers buy insurance through Lemonade, the company will collect more data, sharpening its ability to predict risk. In turn, that should translate into lower prices, making Lemonade a more attractive option to all consumers. Of course, Lemonade hasn't been around long enough to know whether this theoretical advantage actually holds up against industry titans like State Farm and Geico, but the early indicators are very promising. The company posted a gross loss ratio of 74% in Q2 2021, roughly 8 percentage points lower than the industry average in recent years. And Lemonade has grown customers and gross profit at an impressive pace. Lemonade recently announced that it would soon be launching an auto insurance product, Lemonade Car. This adds $300 billion to its addressable market cap in US, bringing the total to over $400 billion. That move should have investors excited and option traders sharpening their spears to go on a hunt. So why don't we jump into my screen again and go hunting with Uncle Henry? All right, let's take a look at Lemonade. Lemonade is down 6%, which is again a really good thing because now we're getting a discounted price to buy and call options. As you guys can see here, Lemonade was trading for $80 not long ago at all, and now this is an under $70 stock at $68 per share. And I honestly believe Lemonade has a lot more room for upside than Activision. Activision is more of a long-term play, so maybe you would even want to go out longer than January, but I still think in January would be successful. But with Lemonade, goodness, we could actually go back to about $80 in the very, very short term, which would be amazing, right? The first thing I'm going to do is go to trade LMND options. And I really like this stock because it's a really good insurance stock. They're really disrupting the industry. I've actually used their service and it was super easy. It literally took like a minute of my time. They were very, very customer friendly and I was super happy with them. I live in Airbnbs now, so I don't really need their services, but if I did need them, I would totally go with them. And I'm not sponsored by anyone. All right, looking at LMND, so I think it could be like an $80 stock. So any of these strikes would be amazing, 69, 70, 71, 72, because what I'm really looking at is the break even. And if I believe LMND can be 80 or 85 or even $100 per share eventually, then any of these would be very, very well suited. Now I'm looking at the wrong date. I do want to go to January 21st, 2022. That would be a lot more time. It would make a lot more sense because I don't like buying short-term call options. They usually end up not going too well. And it's because you pay a lot of money and you need something to happen really, really quickly. And sometimes it happens and it works out, but most of the time you're going to be losing maybe 70, 75% of the time. Obviously it depends on the delta, but most people are going to be buying something like 100 call option. And if you take a look at the delta, it's 20. So you're going to be losing 80% of the time. Instead, don't do that to yourself. Just listen to Uncle Henry. Uncle Henry got your back. I would go for something like 75. And the reason why, again, I'm going closer to the money is because you have more delta. You have more opportunity to make money. If Lemonade was to go up to 85 per share or $90 per share, you're going to be making money on this 75 call option, and you're certainly going to be making money on this 70 call option. And this 70 call option looks really attractive because if LMND went up to $85 per share, then you're paying about $960, but you would make a profit of about $500, or in total you would make about $1,500, and $1,500 divided by 1,000 is a 50% return. So you'd be making about 50% in just 3 months. Obviously, I wouldn't put your whole entire retirement into this, but I think it's a very strong play for a $1,000 trade, which is not a whole lot, and you can make a 50% upside. Again, it's riskier than some of the other strategies that I really like. If you want to know what strategies I like, I'll have the links for you below in the description. It's selling puts, put spreads, and all of the other stuff that I talk about, and mainly selling options for income. However, I'm really looking at the $70 call option. I think there's a 50% return here. If you take a look at the 75 call option, you're going to have to put up only $775. However, if it was to be $85 per share, you would be making about $10, and $10 divided by 775, you're probably going to be making around 30% return. Maybe it's 33% returns. Your return does go down. That's why I would probably, if I was going to be buying call options, which I am not, I don't usually like buying call options except for Lulu, which I made a absolute killing on, and you guys can watch that video as well. I really prefer going for something with more delta, more closer to the money. That way, when the stock does go up, I get to participate as much as possible. And honestly speaking, when I'm really bullish on a stock, there's something called stock replacement strategies, which is just buying in the money call options. What that would look like would be like buying the $65 call option. And as you guys can see, your break even actually continues to go down. However, you need a little bit more capital here because you're gonna have to put up a little bit more money. But if I look at the 65 strike, I can guarantee, I can promise, absolutely promise before I scroll down, that it is going to be above 50 delta. You guys ready for this? Boom, 62.96, basically 63%, right? This is going to be a much safer play because it's an in the money option, and an in the money option has a higher delta. I already knew it was going to be above 50 because an at the money option is always going to be 50. So an in the money option is going to be higher than 50. So basically here we have a 63% chance of making some type of profit on this trade. We would of course need the stock to go up about 12% to break even. But again, I've seen Lemonade at $100 per share. So I think this is a very strong play if you're going to buy call options. The third stock I have is Square. Traditionally, small and medium-sized businesses, or SMBs, have turned to banks and independent sales organizations for merchant services. But these providers often require long-term contracts, and they typically bundle hardware and software from different vendors, which can lead to compatibility issues. That's what makes Square so compelling. There are no contracts, and its self-service platform offers all the hardware, software, and services sellers need to run their business. I also see a disconnect in the stock. The disconnect is roughly 8.5%. Take a look from August 23rd until now. We had triple peak on August 23rd, then the 30th, and again on September 3rd. That's important because if Square can retouch these levels on the technical chart, that's 8% gap that it would bridge, which would move a short-term call option a significant amount due to the nature of leverage in an option. Oftentimes, an 8% move can be 3 to 5 times more, so it would be a 40% gain on an option. So with that being said, let's jump into the last option analysis I have for you guys to get stupid rich. All right, for the people that are making it towards the end of the video, I want to reward you with some analysis on Square. So Square is the last stock, obviously, but I want to do a little bit of an extra deeper dive into Square. So if you guys take a look at my screen right now, I have the moving average, the Bollinger Band, And what you guys will notice here is that Square considerably fell below the moving average, which is this purple spot right here, this purple line. Square tried to touch the moving average and then it dipped below. Of course, the whole entire market is dipping below, and Square is actually only down 3%. And I've seen other growth stocks related to Square, like Tesla, down a lot more, about 4%, right? I think Square actually has a lot of resilience. I think this stock has tremendous support. It's already below the moving average. It's below the Bollinger Band moving average as well. And I actually don't see it really trending down a whole lot more. What I actually see happening, I'm gonna actually zoom in here to the 1 month. You guys see here, this is a little support here at 246. It bounced off heavily, right? I mean, it tried here, and then we have this little cup formation forming right here. So that little cup right there, it's a very good support. I like to see that. It's like a coffee mug, right? And then Square was trying to go up and then it went down. And basically this is because of the overall market, but I believe that Square is just being dragged down by the entire market. And I don't actually think it deserves to be dragged down. What I think is going to happen is Square is going to bridge the gap and it will certainly go to $256. Again, I'm not a financial advisor, so I think it's going to go to $256. I would place an 80% probability on that. But I can also see Square going back to the Bollinger Band average, which is $260 per share. So again, I don't see a whole lot of upside. I'm not going to go, hey, this is going to be a 10x stock, guys. You better come in. I'm going to be a hype stock YouTuber. It's not like that. I do think we have upside, but I'm going to be very modest, especially because we have a lot of turbulence and volatility in the market right now. I'm going to be pretty realistic with you guys, okay? So let's just say $260 per share. In terms of that, let's see what would be profitable in terms of buying a call option. And now I'm not going to forget, I'm going to go to January 21st, 2022. Can you guys believe it's almost 2022? It is insane. I wish that we will all have a great rest of our 2021 and make a lot of money and get stupid rich in 2022. I already know it. If you're watching this part, then just smash the like button, shoot a comment down. I already know that you're gonna get stupid rich. I think it's gonna be about 260, 270. So what you guys can see here is, because I think it's only gonna be 260, 270, buying a call option here would not make sense because it would not be very profitable unless you expect Square stock to go up to about $300 per share. And then I can actually go to 3 months here. And as you guys can see, Square was as high as 281. And take a look over here, our break evens are very close to 281. At least, well, this one isn't, but these two are. So buying a 270 call would make no sense in my opinion. You will probably lose your money. If you buy the 260 call, you'll make a little profit, most likely based on my $280 price target. And $250 would make sense. However, I don't think most people want to pay $2,333 to bet on a stock that is probably not going to rise too much. And if it does rise, this would be a smaller payoff than the other 2 stocks that I covered. So there you have it. I'm actually going to be unbiased and say that Square is a very good buy. But in terms of call options, I guess this video is going to be 2 call options to buy and 1 call option not to buy. But at least you guys understand the full logic of what I'm saying here. So there you have it, the top 3 call options that are likely to crush it. We're up over $500 in less than 2 weeks on my Scaling with Spreads challenge, and I'm taking 7K to 17K in the private group, and it's not too late to book a call with myself and the team, so you can do it too. Click the application link below, and thank you so much for watching. I'll see you guys back here very soon.